Welcome to a weekend edition of the Trading Script, Markets in Motion. Today is Saturday, September 21st, so the question on everybody's mind is, has the market peaked? And are we heading nowhere but down from here? We know some of you out there would like to hear that. However, as per usual, things with the market aren't that simple. While we have indeed been seeing early signs of a peak in the market, these are long-term signs that will still take months to fully develop. For now, and as we said in previous videos, after making a new all-time high, the SPY will have to experience some type of correction. And that's exactly what happened on Friday. But how much of a correction can we expect? What's more, is this going to continue into next week? Well, let's look at some charts and try to answer that question. And if you're a bear, you'll know our forecast may not be that off because, well, it will irritate you. If we look at short-term momentum on the SPY, specifically the 2-hour chart, and at the PPO indicator or the percentage price oscillator, it's very likely that we head lower on Monday. This is because what we can see here is a slight negative divergence between price and momentum, not enough to cause a sudden collapse, but likely to produce more downside, possibly into this area. Although, if the market is too choppy and refuses to go down promptly, we may have to complete this downside movement into Tuesday. The thing is, once we do so, the SPY is very likely to bounce and try to retest those all-time highs. And this is because the PPO is still in positive territory, meaning that the overall momentum is still positive. Also, another reason to support this idea comes from the HYG chart. If we now look at the 2-hour chart of the HYG, or the high-yield bond ETF, momentum is still remarkably positive, even suggesting that the HYG will attempt a new high. This is what we call a positive divergence between assets that will eventually play out, giving more fuel to the market after the short-term correction we are talking about is done. Now, if we jump to the Caterpillar 2-hour chart, we can see that the PPO is very close to having a bearish crossover, supporting the idea that the SPY will still go down between Monday and Tuesday. Nevertheless, there still isn't enough evidence to support the idea that a major correction, or even a crash, is coming next week. And if we now look at the VIX, again on the 2-hour chart, this also suggests that the market will still go down in the very short term, as we are very close to having a bullish crossover, along with a bullish divergence on the PPO. However, because momentum on the daily chart has weakened, we no longer see an imminent major correction coming. On the other hand, because the VIX hasn't made a new relative low, this suggests that the market will remain volatile. Furthermore, if the VIX stays in this range for a couple of weeks, it will start to coil or accumulate, potentially announcing a major correction in the second half of October and into November. Now, this is because momentum has shifted from almost breaking out of this downtrend to breaking back down into this descending channel. And again, if we go back to the weekly chart of the HYG, we can see that we finally have a confirmed breakout of the 200 weekly moving average, which signals a new weekly uptrend and more upside in the market, at least until proven otherwise. Nevertheless, because this has put the chart into overbought territory, we now need a pullback, or some weeks of accumulation before we move higher. This aligns with potential weakness coming into October and November. And unless the HYG breaks its uptrend during this process, more upside into December and January next year is very likely. However, a word of caution, we still need to see how bad the actual correction will be going into the second half of October and November, since there's always the potential for this to break the bullish momentum in the market entirely. All this, of course, puts us in a very uncomfortable position as traders because since September 6th, there hasn't been enough volatility to find a long entry. But since momentum remains positive in the midterm, shorting the market still isn't a good option. All this is to say that while it's still possible to use these small corrections to go long in some stocks, position sizing should remain small, as upside is very limited. Thanks for watching, and don't forget to comment and subscribe as we bring you more videos on market and technical analysis.